Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. On Thursday this week, I had the chance to have a catch-up with Matt Hose, who is one of the alternatives analysts at brokers Jeffries. We're going to talk about the renewable and infrastructure sectors and a couple of the other alternative sectors. So, first of all, I guess we should start by saying, Matt, I'll ask you for your general thoughts around the market and investment trusts in particular. We have actually had a very good quarter, second quarter for investment trusts generally, and that includes some positive developments in the alternative sectors that we're going to talk about. So, first of all, perhaps I could just ask you, what's your kind of general impression of how we're going? Are we actually seeing a turn in the alternative sector at the moment? Is the sentiment is improving? If we're finding a few bits coming in for stock, what's your overall assessment of where we are at the moment?
Hi, Jonathan, and thanks for the invite on the podcast again. Yeah, I mean, you've obviously seen the numbers about the performance of the sector this last quarter. I think on the ground, things do actually feel a little bit better. On the sort of technical flows side, it doesn't feel like we're getting a lot of sell tickets, a lot of forced redemptions from holders, which we were getting, say, in a year, 18 months ago. And then on the fundamental side, yeah, we're seeing a bit of bid activity. We're seeing some interesting sort of portfolio sales. So generally, I think things just feel a bit better. I mean, I don't want to be too optimistic because we've sort of been here before when it looks like the sector sort of turned the corner and we've had another dreadful quarter. But fingers crossed that it can all sort of kick on from here.
And if we just think about the factors behind that, obviously you say we're beginning to see some corporate activity in the alternative sectors. So far, most of the mergers, consolidation, wind downs, or a lot of them have been in the equity sectors. What do you think is driving that? How important is the fact that short-term interest rates may be coming down, while, of course, long-term interest rates are going up? So normally you'd think that falling interest rates would be positive for the alternative sectors. They tend to be priced against gilts in some form. But gilts haven't been doing that well. Or is it just a sense that things actually have got about as bad as they can do in terms of investor sentiment? What's your feel about that?
I think the interest rate thing is a healthy backdrop. What it really is, I think there's a few activists around, a few high profile activists. I think what boards are trying to do is just trying to get ahead of any sort of activist involvement and see what they can do in terms of asset sales, corporate activity, big ticket corporate things they can do. And so that's why we've seen a bit of activity over the last sort of 6 months.
Well, let's just start with a couple of names then. I mean, let's start with BBGI. That was an interesting one that obviously got taken out, one of the core infrastructure trusts. Was that a wake-up call, perhaps, for some of the people who traditionally invest in this sector?
A little bit. I mean, I think honestly, BBGI was sort of low hanging fruit. I mean, the portfolio was very sort of low risk, but commensurate for that risk, the return was actually pretty good. There weren't many moving parts of the portfolio because all the revenues were availability based, and it was the quality proposition through and through. So, as a potential takeout, it just made a lot of sense. The key thing in there is I don't think there's a huge amount of read across to the other members of the sector because they're a bit higher up the risk return spectrum. They've got more divergent portfolios. They're also larger as well. So I think BBGI feels like a very sort of one-off type of deal.
So, I mean, in the core sector, we're talking, I guess, mainly about HICL and INPP. And we had an interesting announcement this week about the funding of Sizewell C. What did you make of that?
I see that as pretty positive. I mean, big picture with HICL and IMPP, I think the market sort of wants to know where they're going in a sort of medium term and really wants to get the sort of run rate return a bit higher. And what this deal does for IMPP is it is accretive to their returns. It's also accretive things like inflation linkage, dividend cover, the life of the portfolio. And then it's a very interesting asset as well. People see nuclear and nuclear construction and big sort of red flashing warning lights. But actually, the way it's been structured by the government is there's clearly a bit of risk for IMPP and the other equity holders, but that downside risk is capped. And on the upside, you're getting quite an attractive return with a cash yield through the construction period and then a fairly high run rate return once it's in operations post 2030. So I think it's a good standalone deal. It's a good deal in terms of the overall IMPP portfolio. The only sort of question marks, I think, is sort of how do they fund it, what assets they sell, because clearly our equity issuance is still off the table for IMPP. What's the sort of timing of those sales as well?
Yes, as you say, nuclear has a bad history, but investors have learned from the mistakes of the past. And as you say, they're getting a much better deal than they did first time round, if they were involved in it at all. But it's still quite a brave thing to do, I think. But as you say, it could produce higher returns and maybe a little bit of extra risk. Can I ask you about the water industry? Some of these trusts have some exposure to that. What do you make of what's been going on with that big report into the water industry and how it might be restructured from now on?
Yeah, I mean, that's a difficult backdrop with the sort of political risks in the water industry. It's very difficult for those companies. And obviously, with Thames Water, a bit of a knife edge as well. So then it's a very difficult environment. I mean, that report I think is broadly positive, and if the recommendations in that report were sort of enacted, I think you would get a more sensible regulatory regime for water, particularly with the potential for the allowable returns to sort of move year on year rather than being fixed over the course of 5 years. I think that's helpful. So you just got to wait for these things to be enacted. But then, when we look at specific water names, and the key one obviously is Affinity Water within HICL, that's clearly not immune from the challenges of the wider sector, but that's actually relatively well positioned because it's just a water company. It doesn't have any wastewater business. It is able now to distribute in its current regulatory period, so it can pay dividends up to HICL. We met management team recently, and they feel on the front foot. So Affinity Water is in a difficult sector that actually doesn't feel like a bad asset.
You might just remind us what Affinity Water does. How does it fit into the industry? You mentioned it doesn't do waste, which is obviously important. What are its main assets? What does it do?
It's literally just a pure water company around the sort of Surrey and sort of Chilterns neck of the woods.
Right. Okay. And so, just sticking with the core infrastructure at the moment, the big names, in terms of the performance, in terms of sort of discounts and NAV prices, have you been disappointed or pleased by the way the market's dealt with these various developments?
We've seen a bit of discount narrowing, and I think that's helpful. I suppose the only question really is how much more we'd like to see going forward. I think further interest rate cuts will help there, but the key question is what's going to dramatically change the sentiment for these funds, and that I'm still not sure of.
Right. So, you can't necessarily see that at the moment.
Yeah, that's right.
Yeah. Well, let's talk about the renewables next then. So, again, we've had a big regulatory review. It's all quite complicated. But just looking at the overall picture of where we are vis a vis the renewables, big picture, what's happening as far as the renewables are concerned overall? Let's start with the UK and then perhaps talk about the ones that have exposure overseas. What's been the main news affecting the renewables in the past few months?
It's a bit of a mill pond because NAV are actually very stable. If you look at the sort of bottom up drivers of the DCF portfolio valuations, and so the NAVs, power prices aren't really moving that much. Discount rates aren't moving that much. Inflation assumptions aren't moving that much. So the funds will start reporting their Q2 NAVs actually next week. And we're probably not looking at any sort of huge movements there. But it's what's happening beneath the surface, and I think the key thing beneath the surface is the funds are trying to sell assets, but they're in a relatively difficult market to sell assets. And I think what's happened in the first half of the year, where there's been very few asset sales, is we've had this sort of overhang from REMA. That's the review of electricity market arrangements, and we've had confirmation the last few weeks that the UK wouldn't be undertaking its overall pricing. And it depends what your asset mix, whether that's good news, or if you've got whole wind assets, particularly wind assets in Scotland, that's good news. But really, the impact is now that's out of the way, and now you've got a bit more certainty in the market, then we may see the transaction market begin to pick up. And so we might see some more asset sales come through. Probably not in very near term, but possibly back in this quarter and into Q4. And that's what the funds need to do. They need to sell some assets, repay some debt, and free up some cash for buybacks.
Can you just explain for those who haven't followed this as closely as you've done? The point about REMA, this was a review of the whole way in which renewables are regulated in terms of price and capacity and so on. So the key point is that that review is finally finished. And just explain what zonal pricing was, why that was important. What does zonal pricing involve, and why was it good for some companies rather than others? I know it's a regional factor, but perhaps you just explain that a bit more.
Yeah, sure. So at the moment, we've got sort of one national price. So it doesn't matter whether you're in the south of England, where you're in a big demand centre, or you're in the north of England and Scotland. where you're away from the demand but close to the supply. There's just one price on the market. What the zonal pricing was going to do under REMA was split GB up into various zones, and you'd have separate pricing for those zones. And clearly, in the north of England and Scotland is where a lot of the wind production comes from, particularly obviously offshore. And so in those zones, you would have high supply but lower demand. And so you would probably get lower prices on balance for your electricity you generate if you generate in those zones versus if you generate it in the south of England, for example. And so that was going to be potentially negative for the wind focused funds, albeit subject to those offsets because the grid charges also differ by zone, and those grid cap charges could have changed and acted as an offset. But basically, the wind industry, whether it was Trig, Greencoat UK Wind, or corporates like SSE, for example, were heavily pushing back on this prospect of zonal pricing because it would probably be a net negative for their wind farms. But fortunately, the government has moved away from that, and we're still going to have a national pricing system. So it's a mild risk averted. But the key thing is, post that decision, we've now got a lot more certainty in the market.
Okay, and so let's just mention one bit of corporate activity. We obviously saw that Harmony Energy Income, which is one of the three battery storage trusts, that has been taken over by Foresight, which is one of the bigger players on the management side of this industry. What did you make of that deal and the terms on which that went out? And then we can perhaps go on and talk about the other two trusts and what the outlook for them is. They've obviously perked up quite well. So was it a good deal, bad deal? How would you assess it?
That deal needed to happen because Harmony was basically had a capital structure. The level of debt they had, which was about equivalent to 50% of NAV, was basically unsustainable. And so they either had to sell a material part of the portfolio, sell all the portfolio, or sell the company as a whole. Otherwise, there was potentially a lot of downside to that share price. But fortunately, the board was able to execute that. And actually, there's a small bidding war between Foresight and Drax in the end. And so I think that was a very good outcome for shareholders. And in terms of read across, because Harmony was a wholly UK portfolio and Grid is a wholly UK portfolio, there's some obvious read across there. And the Grid share price has moved higher just on the pure valuation read across. Also, what's helpful with Grid is they have a strategic sort of vision, a 3-year plan, and we've started to see the first few elements of that plan take shape. They brought an equity injection from a third party into one project, and they've got contracted revenue base across the portfolio as well. So that's been very supportive of Grid share price.
So grid shares have been the best performer in this sector, obviously, this year to date of about 70%. But they had obviously fallen a very long way before that, and they're still trading around, what, 78, 79p, something like that, which is still way below the original issue price. Harman Energy Income, it went out at 92p, so that's like 8p less than it was when it launched, give or take. But as you say, in the circumstances, you'd rate that as an essential deal, and it has had the effect of perking up the sector. What about Gore Street Energy Storage? Have you any thoughts on that one?
That one's in a different position because they have some UK assets, but they also have Irish, German, and US assets. We see that one as in a bit more of a sort of state of flux because they're undertaking a strategy review. That's potentially because they've had a shareholder requisition of a general meeting. And under that strategy review, they'll decide, I imagine, which parts of the portfolio to maintain, which ones to augment into longer duration batteries, and which parts to sell. And then depending on what the portfolio looks like after that process, that will have implications for the level of income they generate, the dividend they can maintain, etc. So we've seen one or two sort of positive announcements from that fund recently. For example, when they removed the performance fee, when they removed the poison pill, we've seen a dividend cut, which was clearly less positive, but sort of understandable given that portfolio in flux. And what we're now looking for is just a bit more of a solid view on where they're going sort of strategy wise.
So you would say that there's certainly a question mark over their ability to remain viable in this climate, but they are taking some steps to rectify that. Would that be fair?
I think it's viable, and I think they've got interesting assets in good geographies. It's just the assets are very different. The way they're paid in various geographies is very different. And I think that the portfolio needs to basically settle down and get to more of a well thought out structure, basically.
Okay, and they're still trading around 61p, so they're on a 40% discount or something like that. Grid is on 30%, and Harmony Energy Income went out. What was the discount on that one, roughly, to the reported NAV? Can you remember that?
It was very tight in the end, actually.
They got a bit of a bidding war going.
Yeah, definitely low single digits, I think.
Yeah. So that would be the aspiration. If you were one of the two remaining large battery storage trusts, you would still think it's a growth business, and you would be looking to get that discount in over the next couple of years.
And there's positive drivers there. If you look in the UK, the revenue environment is gradually improving. The transaction market for battery projects is also improving. You're getting a more deeper market in terms of contracted revenue as well. A number of other counterparties will sort of take the other side. So yeah, the backdrop is positive there. But the funds just sort of go through the motion with their various sort of strategic plans there.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So if we look across the sector, next let me ask you about the solar trusts, so the ones with mainly solar. We've seen some activity there, and it looks like we're going to lose at least one there. What are your thoughts on the solar trusts at the moment?
They need to sell assets, really. And what they're largely doing across the three of them is selling non-core assets. And those sales are, there's a process, but they're not exactly happening very quickly. They need to get their sales done to repay RCF borrowings, because those RCF borrowings are still relatively expensive, and to free up some cash for share buybacks. And then obviously the funds have talked about strategic options, and we saw the news on Next Energy, for example. So I think there's clearly a lot going on behind the scenes with those funds, sort of strategically, especially with obviously Bluefield and Foresight talking about strategic reviews as well.
But where we've had a continuation vote, for example, they have passed, haven't they? Fairly easily, in most cases anyway. But remind us what's going on at Next Energy Solar.
So they've got an impending discontinuation vote. That's about this time next month. The asset sale program has been slow, and in terms of the quantum of assets sold has been disappointing. And then clearly we've had interest from other parties. I think on a discontinuation vote point, yeah, we've seen relatively low proportion of shareholders voting for various discontinuation votes. I think that's interesting. I actually think that's a bit of pragmatism on the point of shareholders, because these funds, the core assets, are sort of rock-backed operational projects, and there's not at the moment a huge market, so a huge sort of private transactional market for these projects. And so what you don't want to see is the funds that are going to manage wind down and then potentially try to sell assets which they currently can't do. And I think shareholders realise that. And also shareholders are very supportive of the asset sales the funds are trying to do, the non-core asset sales, and also the sort of strategic moves the board are making as well. So I think shareholders just basically realise that these votes will probably get triggered again next year. But for now, just giving the funds a pass.
Right, giving them a pass, yeah. So it's not exactly a ringing vote of confidence, but it's perhaps a realistic one. And I guess this is partly because the share registers of these trusts on the whole there's still quite significant institutional shareholdings in many of these trusts. So they are trying to take perhaps a more pragmatic approach than some others.
Yeah, that's right. Yeah.
But looking at the sector overall, do you think that we are definitely going to see more either consolidation, there has been talk of some mergers in one or two cases, or more corporate activity? I mean, is it going to shrink essentially as we go through this discount unwinding process? Do you see a lot of corporate activity as well as this potential turnaround in sentiment? We saw, for example, that a couple of activist funds have come out and said they're going to focus on the alternative asset space. That's mainly asset value investors, and MIGO now are part of their stable. So how do you think this is going to play out from here?
I think without doubt the sector's going to shrink. I mean, the most obvious mechanism is sort of takeouts. I mean, all I'll say on that is it's easy for us to sit on the public side of markets and say, this fund should be taken out or that fund should be taken out or it's right for takeout. But these transactions are difficult to get over the line. And then a lot of funds have certain impediments where it can be the debt structure or off balance sheet liabilities or poison pills that which make takeouts difficult. And so where we see the potential for takeouts is only in very limited circumstances. If we go back to renewables, for example, we don't see the potential for renewables to be taken out. We sort of publicly put that in a research note. We just don't think the sort of takeout maths works. What's more likely in the renewables case is consolidation, where we get some sort of merger pairs and the funds just sort of circle the wagons by merging. And that gives them larger portfolios and larger pools of non-core assets they can sell and a bit more capital flexibility in terms of debt repayment and buybacks, and waiting for conditions to improve, either that you get a better transactional market where you can sell large parts of the portfolios if you need to, or you get narrow discounts in the closed-end space, which sort of alleviates a bit of pressure.
Right. So it's a complicated situation, the pressure for consolidation, but also I'm interested you say that there's not much scope for takeouts. I guess the fundamental question that some people might ask, looking at the renewables in particular, is the discounts have obviously got very wide and they have been fairly persistent. Could it just be that the assets aren't as good as people think they are, or their NAVs suggest they are?
I think the NAVs are actually pretty realistic. If you look at them on a bottom up basis and you go through the underlying valuation assumptions, they're all broadly sensible. There's clearly a range between aggressive and conservative, depending on which fund it is. And actually, some funds might have aggressive cash flow assumptions, but conservative discount rates, etc., and other funds vice versa. But I don't think the bottom up NAVs are hugely wrong. And then when you look at it top down in terms of transaction comps, then anytime we get to look at the valuations versus any sort of meaningful transaction, again, those valuations are broadly in the ballpark. So I don't think the NAVs are wrong. It's just in some cases, the capital structure of the fund is too aggressive. The funds have been left with gearing, which is a bit higher than they'd like. And then there's technical dislocation in our market where through 18, 19, 20, 21, the big buys of these renewable funds were sustainability type funds, multi-asset funds, retail, and those three sets of investors, or especially the first two, just aren't really buying these funds in any meaningful size anymore. Retail still picks them up a bit for the yield. So I think it's that basically. They just lost an investor base over the last 2 or 3 years, and that's reflected in the share prices.
Some of the yields on these things are still very, or at least in headline terms, look attractive. And in terms of the bigger ones, obviously the UK winds and so on, and Bluefield Solar and so on, you would say that the dividends are pretty secure looking ahead for at least the next few years anyway.
Yeah, all that's on the dividend cover front is you got to put UK wind to one side because it's got structurally high cover and their dividend cover is very strong. And that's a key part of the sort of investment case for that fund. With the others, we're like to see dividend cover ebb a little bit over the next few years because a lot of the funds sort of fixed and hedged the high power prices post Russia's invasion of Ukraine. And at the very most, that was over sort of a 3-year period. And so those fixed and hedges are running off. I mean, the last one should feed out in sort of H1 next year. And that will move dividend cover probably on average from sort of 1.3 times to possibly 1.1, 1.2. So there's still excess cover there. It just cover's not as strong as it has been. And then if they are selling assets, obviously that can have an impact on cover as well. So that's something we ought to just keep an eye on.
Right. So my final question about the renewables really revolves around whether you think the boards are handling this well or not. I mean, you could argue maybe they should have got round to some of this earlier on. But in terms of, for example, in private equity, we've seen a lot of trusts coming out with capital allocation plans, strategies, if you like, to get the balance right between these various elements, paying down debt, getting rid of assets, and so on. Do you think that boards of renewables generally are doing a good job in that respect, or are they doing a good job a little bit too late? Or are they still behind the curve in one or two cases?
I think we were, for example, pushing in from sort of 2021, 2022 onwards. These funds should be recycling capital more. And they shouldn't just be acquirers of assets. They should actually look to sell assets and recycle capital into construction development opportunities and so on and so forth. We've started to see a bit of that. But yeah, the funds are relatively late to be doing that. I think now they're a lot more on the front foot, and you can see that with the various sort of strategy reviews and things that the various funds have done to make themselves more shareholder friendly. Part of that will be boards waking up to the current environment, both what's happening in the closed-end fund universe, but also what's happening in the sort of private market. And some of that will be a little bit reactive to the fact there's a number of activists out there now. And so boards have to make sure that they're doing everything they can to support shareholders, or those activists may turn up in the register.
Yeah, so that's certainly been a story of the last couple of years. Yeah. And the threat of activists seems to be, in a way, more potent than simply taking corrective action because the discount's so wide. But a lot of these trusts are still trading on 20% discounts or worse. So would it be an aspiration for the sector overall to get those discounts into, say, 10%? Would that be a realistic ambition if you are sitting on the board of one of these trusts?
I think given the issuance, the sort of quantum of issuance they made at material premiums, then I think, yeah, you have to get the shares back into at least a 10% discount. And then you've got a fighting shot at getting close to NAV. But yeah, at the moment, there's been progress in discounts, and that's good. But we need to see further progress.
Yes, I mean, I just had a quick look at some of the longer term annualized returns from these things. And when they came to market, when we had the big issuance splurge, if you like, before the discount started to widen, everybody was talking about 7-10% returns with decent dividends. And yet, if you look back at the history, the great majority of these trusts have not delivered that, essentially. They've delivered single digit positive returns over 5 and 10 years. But they're basically, in sometimes 1, 2, 3, 4, 5%, that sort of thing. So it has been disappointing, I think it's fair to say. So they do need to put that right, do they not? Or else the market will eventually do it for them.
Yeah, that's completely it. You've got assets which deliver you positive absolute returns at the portfolio level and the NAV level, but it's no good if your share price basically doesn't give you positive returns. And we've been here before with funds of hedge funds, with credit funds, and now with much more broader real asset funds. And that's why you need good governance, strong discount control, basically, because yeah, the weak share price returns just it's not going to cut it for any serious investor.
I would like to ask you about another much smaller sector. Well, not that small, actually, surprisingly, but that's the digital infrastructure sector. We've got two survivors in that sector, I think it's fair to say, and they've had very contrasting fortunes. Digital 9 has been essentially a complete disaster, but maybe there's a little bit of value to be saved there given how far the share price has fallen. And then we've got Cordiant, which has also sold off in the same way as Digital 9, or not quite as much, but has been performing much better. So, what's your take on that sector? Is it actually make any sense to talk about it as a mini subsector?
Yeah, I think there's only one survivor, really. I don't think DGO9 counts as having survived anything. It's pretty much dead on the floor. Look, I mean, what value is left there? It sits now in Arqiva, basically. But that's an asset. They can't really even start to sell for a couple of years. They need to wait for the inflation swaps to expire. So it's almost an irrelevance for now. Cord, on the other hand, has done a very good job. They're in core assets which are demonstrating strong growth, so CRA and MTL. But the other assets, actually, things like Speed Fiber Group is also performing well. Management team continue to execute on the business plans, both at the core level and at the underlying company level. And I think there's the potential for syndications of some of the larger assets down the track as well, which will be very useful in terms of releasing some capital, but also validating the valuations. So I think Core's in a very good place.
So the shares, according had a very good rally. They've come up from about a 40% discount, and it's now into around 20 something, I think, percent. They bottomed around 60p, and it's now trading around 90, 95, something like that. But you think this is both a survivor and potentially could justify its existence in a way that some of the other trusts will not?
Yeah, look, I think it's a really interesting strategy. For me, it's all about backing the management team. The pushback we get on Cord is the geography of the two larger assets, being sort of Central European focused, and the overall concentration of the fund. I understand both those points. But really, for me, it comes down to the management team and their execution. And so far, they've executed these assets very well. like I said, they're growing earnings, and in time they'll transition these assets from legacy broadcast type assets to actual digital infrastructure companies, whether it's data centers or towercos, and achieve a higher valuation multiple in the process. So it feels like it's more of a NAV story than a discount narrowing story, given that discount narrowing we've had. I mean, the discount could narrow a bit, but I think the share price returns going forward are really going to come from the underlying business growing earnings.
Okay, overall then, Matt, obviously, as you're giving us a clue or an indication that business has picked up a little bit, and there are lots of reasons to think that there'll be more activity in this sector, one kind and another. I guess as a broker and a broker's analyst, you're beginning to think that maybe the tough times of the last 3 years may be coming to an end, or indeed may already be over. I've never met a broker who wasn't particularly optimistic, but would that be a decent way to round this off? And tell us what your overall thoughts are looking ahead.
Yeah, you have to, I think. No, look, I think we've had a good quarter, like you say. I think we just need more of the same in the second half of the year. So on the technical side, we just flows, we want to be supportive. And then on the fundamental side, we just want more corporate activity. And that will hopefully get things, share prices moving higher.
Is there anything to be gained from the fact that UK equities generally are attracting perhaps more attention overseas? Do you think that we will get international investor interest in your sectors as well as in the UK equity market? We have seen a little bit of that, but not obviously nearly enough. But are you seeing any signs of that happening as well?
Hopefully. I mean, the big problem is that even to investors who have UK benchmarks, they benchmark against the X investment companies versus the version of the index. So that's not helpful. But just what we're seeing from our clients, we've got a much broader range of clients than we had, say, a year or 2 years ago. A lot of clients just call us up and say, look, we understand there's a dislocation in UK closed-end funds, which are the interesting ones. And if the UK is becoming a bit more sought after, a bit more in vogue, then that can only be a positive. It's not going to be a negative.
Well, we like to end on a positive note if we can, though it hasn't been easy for quite a while in some cases. But anyway, Matt, thank you so much for joining us on the podcast. That was Matt Hose, the alternatives analyst at Jeffries, the brokerage and investment banking firm.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.